I'm Owen Bigland. This is the Inside Edge video blog. Well, it's Saturday, so let's do a kind of a lighter blog here. One of my investing, the mindset you need to achieve financial success, the long-term investor mindset as opposed to the market timer speculator mindset, which is a mug's game and will never result in much in the way of financial success. So I want to give you guys kind of some insight. I think you guys are going to enjoy this blog. I've as you guys know, I blogged about a few times here how I'm about a month and a half ago decided that I'm going to get some equity out of a couple of properties that I have. These are properties that I've owned for many decades now that are clear title for me. So I do not hold a mortgage on them. They're investment units. And with the low interest rates right now, I've decided I'm going to tap into a bit of equity. And with some of the buying opportunities I've been seeing in the stock market, I wanted to get some money, some more dry powder and put it to work. So that all came through for me now. So I've got some nice bit of dry powder here ready to put to work. A good portion of it I'm going to put into the stock market, mostly US equities. I'm more bullish on US equities moving forward than Canadian, although I still like a lot of Canadian equities. I still, like Bell Canada, and the banks are pretty reasonably valued here. CN Rail, I just recently bought some Suncor, which is a bit of a speculative play. And I like the dividends they pay, and I also like the dividend tax credit I get on my Canadian holdings. But I'm probably a fair bit more bullish on US equities going forward. But I had you guys know, I've got a lot of good long-term mentors that have helped me a great deal. One of them is a few people I've got in New York City that are in the money management business, private equity business. These guys are Wall Street veterans. One guy in particular who has been very good to me over the years. He's kind of my go-to guy. We talk probably at least quarterly, every 3 months or so, and we'll talk a little bit about the stock market and what he's been buying. We trade emails back pretty much on a weekly basis. So now that I had this new bit of capital ready to put to work, I called him earlier this week and had about a 45-minute conversation with him. So I'll share with you guys some of the things we kind of talked about. Now, the money I've got here, a lot of it is going to go into US equities, some into Canadian equities. I'm not going to buy it all in one shot. For the simple reason that, the real buying window was back in late March and early April. I mean, if you follow me on Twitter, I put it all out there like I always do. Some of the stocks that I was purchasing back in March, April, didn't purchase nearly as much in late April or into May here because I ran out of funds to put to use. But a lot of them will go into US, some into Canadian equities, and then I've also earmarked some funds for purchasing another investment property in Vancouver over the next 10 to 12 months. I'm not waiting for some magical price to buy this property. It's really more about a few select buildings that I'm interested in. I really want to buy another investment property in the West End. I currently live in the West End. I've got my eye on a couple of buildings here, very close, 5-minute walk from where I live. And that's kind of what I'm waiting on. We're just waiting for the unit in a couple of select buildings to come up and then probably looking to buy. Here's the conversation I had, though, with my New York guy. The thing that he always has stressed with me, that he's been pounding home for over 20 years now with me, is that, Owen, never lose sight of what your advantage is. You have, as an individual investor, you have a huge advantage over institutional traders. And it's really, you only have one advantage. You only really have one thing going for you. And that is you have the ability to buy high quality names, high quality companies with strong balance sheets, incredible cash flows, wide competitive moats, long histories for the most part, not all, but most of the companies I hold not only pay me a dividend, but also have a continuous track record over the last 20 or 30 years of raising that dividend. You buy these companies and then you sit on your ass. You hold. That is your huge competitive advantage, and I talk about it in my book. People need to realize that. You have a huge leg up on these these professional money managers. That in the fact that you can just buy, collect the dividends, and then reinvest it. And that is a strategy that has worked out incredible for me over the last 30 plus years. Not only in the stock market, but something that my father pounded home to me in real estate starting 33 years ago when I bought my first investment property. He said the exact same thing. Owen, this is way before I was a realtor, you have a huge advantage. Just buy good units, good homes, put tenants in them, or buy your principal residence and keep the damn thing. Because real estate, of course, is not something you trade. It's not like a stock where I get my trades for free now. I don't pay a penny to buy and sell Apple or buy and sell shares in Coca-Cola or Pepsi or Johnson & Johnson. It's free. For most people, though, it's only $9.99 a trade. It's nothing. Selling real estate, on the other hand, getting in and out of real estate is one of the most expensive assets you can buy and sell. You've got commissions. I don't come cheap. You've got property transfer tax. You possibly have GST. You've got lawyer and conveyance fees and moving fees and everything else. It's an incredibly expensive asset to get in and out of. So don't play the trading game with real estate. But he's always been pounding home to me the big advantage that individual investors have like me, and that's just to buy good quality companies and hold them for long periods of time. Keep an eye on them, monitor them, because even the best company can run into hard times. But for the most part, these good companies get out of the hard times. They might have a bad CEO or bad quarter or here and there. Unless the business model changes drastically, just hang on to these good companies as long as the cash flows keep coming and they keep raising the dividends. So I had a long conversation with him and he pounded home again, just stay the course of what I've been doing and had tremendous success with over the last 30 years, which I have. Don't play the trading game and the speculating game. And, moving forward here, there was some tremendous buying opportunities, as I said, in March and early April. I mean, I bought Disney at $80. I picked up some McCormick. I bought some Nike, some Starbucks at pretty good prices. It's funny, I have it all in my Twitter feed there. The market from the bottom here, with late March or mid-March, is up probably S&P up almost 25 or 30%. It's been an incredible turnaround here, and how resilient these markets are, and how you're best just to stay the course. Don't panic and sell, which a lot of people did. Just stay the course. And if you have some money to invest, in hindsight, you should have been buying during this March and April window. But buying and holding good quality companies is the way to go. A couple other things we just briefly talked about. We talked about Warren Buffett. Warren Buffett had his annual shareholders meeting a couple of weeks ago. Buffett has been very quiet lately, although he did sell all his airline stocks. And if you follow Buffett, Buffett for many decades, he got burned on airline stocks back in the 90s and vowed never to buy airline stocks again. But he broke his cardinal rule and bought in on a lot of the major airlines about 5 years ago. He just recently sold all his position at a huge loss. And, he was kind of joking about it. He never should have listened to himself. But hey, it is what it is. And in my opinion, Warren Buffett gets a pass. Most successful investor in the world. Even the most successful investor in the world makes mistakes. But my friend in New York was saying, it's just another reason why Warren Buffett is such an incredible investor. Because Warren Buffett said in his press conference when he sold those shares, says, hey, you have to be willing to change your mind when the circumstances change. And in fairness to Warren Buffett, those airline stocks were doing quite well for him. He actually had done quite well on them until COVID hit, which was totally out of left field. It was a black swan event. That's what killed the airline stocks and knocked them down 50 and 60%. But these things happen. But when the circumstances change, Buffett was quick to realize that we are in a different world moving forward here with COVID-19. These airline stocks are never going to be the same. Some will probably have to file for Chapter 11. Hospitality stocks, airlines, hotels, travel. These are going to take, cruise ships. These may never come back to the levels they were. It's going to take many, many years. So Buffett is the first to realize that when the circumstances change, he's willing to change his mind, and he's willing to admit that he made a mistake. And this is something that's so important, and this is something that I see play out in Vancouver real estate here. You guys, I'm sure, have noticed it too. I mean, we've got these people out here that have been bears, doomsdayers on Vancouver real estate for decades now. Even though the long-term benefits of real estate is all that really should matter. But some of these guys, they are so invested now in their narrative that the Vancouver real estate market is in a bubble and it's going to crash. Even when you look at the long-term fundamentals of Vancouver real estate and how strong they are, immigration, 40,000 people coming into the Lower Mainland every year, lack of supply, we're never going to build enough supply. It's a trickle-in supply. Interest rates at 2.2%. Don't fight the Fed, all the stimulus money that's coming in. But yet, the circumstances change, but they never really change their narrative. They're still, they get a glimmer of hope with the COVID thing, thinking this might be the time now where it does bring down the Vancouver market 40%, and I'll be proven right. When I've been saying all along that Vancouver real estate, just like stocks, don't go up in a straight line. You have to realize that. We should get a correction in Vancouver real estate every 3 to 4 years. Our average is 5 to 15% correction. We should get something more severe than that, 20% or more, about every 10 years. So these things are pretty normal and they should be expected. You could buy a house today and it could go down 15% in a couple of years, but shouldn't really be of too much concern to you if it's your principal residence or if it's a long-term investment property. Just like what's gone on with the COVID thing in the stock market. Sharp sell-off, but it generally recovers. Stick with the long-term fundamentals of these good companies and owning good real estate. But many of these people, this negativity, this doom and gloom, it becomes their whole persona. They don't want to go back on it now because with their luck, the only luck they have is bad luck for most of these people. It'd be just their luck that they, hey, look at the circumstances and the long-term fundamentals and say, hey, maybe it's not a bad time to buy your first home. And with their luck, the market will turn 10 or 15% down the following year. So instead, they stick with it. They just won't give it up. They're like a dog with a bone. Good investors, people that look at the long-term picture, are willing to change their mind when the circumstances change. For me, I only focus on the long-term fundamentals of just buying and holding Vancouver real estate. And that's all that you guys should do as well. If you're a speculator or a flipper and want to buy homes and flip them and fix them up, then that's a different story. You could probably read all those stats and try and predict where the market's going, although even there, it's a guess. I would just do what my friend and mentor in New York, who is an incredibly successful guy, 30 years experience on Wall Street, and he's also a pretty savvy real estate investor too, has a huge real estate portfolio. Same setup, just buy and hold. I would take his advice. Focus on the long term. Don't worry about what Vancouver real estate does 6 months from now or a year from now. Same thing in saving for retirement. Buy good quality companies and just hang on to them. That's your advantage. That's the advantage you have. If you want to play the trader game where you're getting in and out of positions, forget about it in real estate. As I said, it doesn't work in real estate because your transaction costs to buy and sell are $40,000, $50,000, even more if you've got capital gains. But even in the stock market, it will very rarely ever work out for you. You're not smarter than these Wall Street guys. These guys have all got finance degrees, economics degrees. They've gone to Harvard, to Yale, to Columbia. They've got a team of people that are doing research for them, these quants and everything else. They're going to eat your lunch if you want to get into the trading game. Look no further than, I know some of you guys follow Dave Portnoy, the president of Barstool Sports. So since sports are off, and he's a bit of a degenerate gambler, he's been threw $3 million into a trading account, has been trading stock the last couple of months. You can follow his escapades on his Twitter feed. But as I speak now, I think he's down about $1.2 million. Even he will tell you it's a mug's game, but he's just doing it for shits and giggles. He's got the money. He's worth $50 million. It's just entertainment. But you're not going to win the trading game. Just buy and hold good quality companies and stay the course. Same thing with real estate. I'm Owen Bigland. As always, thanks for watching. I'll see you next time.